Hi friends. Stay blessed. Today we will glance through the summary of the 7 secrets to investing like Warren Buffett. Warren Buffett's success in investing has made him a household name and earned him billions of dollars. As a result, many people seek his advice on how to achieve similar long-term success. Mary Buffett, his former daughter-in-law, and Sean Saya, another expert in Buffettology, have identified the 7 most important secrets to creating a successful stock portfolio. These secrets will be discussed here, including the importance of creating new habits, investing within your circle of competency, and identifying undervalued companies as opportunities. 1. Good habits: saving money and avoiding debt. The key to creating wealth is by forming good habits such as saving money and avoiding debt. Before investing in stocks, it is important to set aside funds, and saving is one of the most important secrets to success. It is recommended to put away at least 10% of earnings into a separate savings account, but if this seems too much, starting with incremental savings is also a good idea. It is important to keep things manageable and consistent when forming a positive habit. Building a solid emergency fund and arranging an insurance policy can help cover costs in case of an emergency. Wealthy people save money, put it aside, and grow it, whereas those who squander their fortune are the ones who have not developed such good habits. 2. Winning strategy: the principle of value investing. The second secret to investing like Warren Buffett is value investing. Value investors, like Buffett, determine a company's true value and whether its stock price matches that value. By studying the market and looking at the right numbers and reports, investors can find undervalued stocks, which means they can identify businesses whose value is greater than what their stock sells for. Studies show that investing in undervalued companies is a strong strategy compared to speculating or going with a gut feeling. Patience is also important in value investing, as it is possible for an undervalued company to become even more undervalued after investing. However, if the company's true value is recognized, the investment will eventually bring a healthy return. 3. Logic and your interests to find investment ideas. When starting value investing, it's important to invest in businesses you understand and are familiar with. Warren Buffett, for example, invests in businesses he knows well, such as Coca-Cola and American Express. It is highly recommended to create a circle of competence by identifying your interests, expertise, and spending habits, which will help you determine the industries or categories of businesses that fall within your area of expertise. By doing so, you can create a starting point for researching and investing in companies. 4. Economic moats of companies to withstand changes in the marketplace. An economic moat is a buffer against losses that protects a business from market ups and downs. It can be identified by a company's ability to offer a product or service that resists cultural trends and price competition, as well as having an efficient production model or economy of scale. Examples of companies with an economic moat include Coca-Cola, Pampers, Nike, McDonald's, Burger King, and Amazon. However, economic moats may not last forever, especially in technology-dependent industries. It is important to consider a company's dependence on innovation to determine if its economic moat is sustainable. 5. Learning the language of business. To invest like Warren Buffett, it is important to understand the language of business, including reading financial statements. The 3 main financial statements are the balance sheet, income statement, and cash flow statement. Analyzing the debt-to-equity ratio, return on equity, and cash flow history can help determine the financial health of a company and make smart investment decisions. 6. When to invest by comparing net current value to the stock price. One must know the use of net method for value investing, which involves comparing a company's net current asset value, NCAV, with its net current asset value per share to determine if the stock is undervalued. The NCAV is the leftover value of a company's assets after paying off all debts, and it can be calculated from the balance sheet. To use the net method, the current price per share should be 1/3 less than the NCAV per share to provide a 33.3% margin of safety for investment. 7. 5 basic rules to manage a diverse and well-protected portfolio. Managing a diverse investment portfolio to allow room for error and maintain overall profitability is significant. Warren Buffett holds hundreds of private businesses and shares of more than 40 publicly listed companies, emphasizing the value of diversification. The 5 rules of portfolio management include fund allocation, not putting more than 10% into any single stock, ranking prospects, reviewing the portfolio at least once a year, and not selling based on price alone. Investing in strong companies when their stock prices take a dip can be a good strategy. These secrets should help individuals make well-informed investments. Final words. To invest like Warren Buffett, there are 7 secrets to follow. The first is to develop good financial habits such as saving regularly and building an emergency fund. The other secrets revolve around value investing, identifying undervalued companies, and investing in them. Buffett also suggests investing in businesses that are within one's circle of competence to better understand their operations. Moreover, investing in companies with a strong economic moat helps them withstand economic challenges, and maintaining a diversified portfolio is essential. Thanks for being patient with me.